just for yes, for housekeeping, this webinar is being recorded, so we'll send that out afterwards. We also have the Q&A function open for questions. I think we are covering a fair amount of material, so we will try and get to questions as they come up. But if we have to push them to the end, we can actually capture them all. And if there's anything that we don't address, we can reach out to you individually with the response. So thank you all for joining the January Multnomah Group webinar. Today's topic is an update on a few regulatory items. As some of you may know, we issue our annual regulatory update, which is usually comes out in October. We knew this year that there were very likely going to be a couple things happening towards the end of the year, and they did. We got the final DOL rule that pertains to ESG investing. And then, of course, at the very end of the year, Secure 2.0 passed. So my name is Greg Johnson. My name is Greg Johnson. I'm a senior consultant here at Multnomah Group, and I'm the director of our ERISA Technical Services Committee. Candace Finn supports me on that committee. She is a retirement plan analyst with Multnomah Group and a second-year law student. So the two of us will be presenting today. Real quick, for those of you that might not be familiar with Multnomah Group, we are what I would consider a sort of a super regional retirement plan consulting firm. We have over $25 billion in assets under advisements, 9 consultants working on over 130 clients and 228 plans. So that's just a quick update on Multnomah Group. Before I turn it over to Candace to talk a little bit about the ESG rule, just to give you a sense of sort of where we're at from a regulatory standpoint, I think these are some quality updates that we're seeing. We'll talk a little more about Secure 2.0 and how it ties into some of the retirement provisions. But I think what we're seeing is a continued interest in trying to improve the overall retirement system. And one of the items that's sort of been political ping pong is certainly this ESG rule. So the Department of Labor has finalized their rule. I'll let Candace talk through what those provisions are and then sort of walk through some of the history of where we're at and sort of what our recommendations would be for plan sponsors who either have ESG focused funds in their plans now or are thinking about adding them. So Candace, I'll turn it over to you.
Thanks, Greg. The Department of Labor's final ESG rule, environmental, social, and governance factors. This bill was actually originally called the Prudence and Loyalty in Selecting Investments and Exercising Shareholder Rights. But even though, it doesn't mention ESG directly in that, it does address some of those issues that we've kind of seen in the past. So first up, of course, is, the investment decisions must be based on risk and return analysis, may include economic effects of climate change and other ESG considerations. This same analysis can also be used in selecting a QDIA, which is a qualified default investment alternative. So, you can use ESG considerations when selecting your QDIA. There's still you have to do that the same as you would do any other investment. So that's some caution there, but just something to keep in mind. Third is the tiebreaker standard, which allows considerations of collateral benefits when comparing similar funds. And then lastly, consideration given to participants for non-financial preferences when selecting investments in a plan. So, you can take participants' considerations into that. It wouldn't be a violation of your fiduciary duty, but to do that with caution, of course, because you have to act prudently in, the best interest of all of your participants and in the plan. Greg, any additional items to add to that?
Well, ESG investing continues to be just a political hot button. And, while we have this final rule from the Department of Labor, it could certainly change. So let's think about the history of, what's been going on relative to ESG investing. Right before the last presidential election, literally a week before the last election, the Trump era Department of Labor issued a rule related to ESG investing. And it would have made it very challenging for plan sponsors to take some of these factors into consideration. So it was really quite the opposite of what you're seeing here. Shortly after the Biden administration took over, the Department of Labor announced that they were not going to be enforcing that rule. They issued a proposed rule back in 2021 and then came out with this final rule. Outside of retirement planning, I think if you're watching it at all, you've seen that conservative states have sort of taken aggressive action in how their funds are invested, pulling them away from companies that are deemed to follow ESG standards or that appear to be following ESG standards. Most notably, BlackRock is one that's sort of been targeted by these conservative governors. So it certainly isn't settled outside of retirement plans. So if you're running a retirement plan and you're thinking, well, this is great, I'm going to offer ESG investments in my plan, or I already do, I think there's no question this rule allows that very clearly, right? So you can take these things into consideration. One big change from the Trump rule was allowing it in the QDIA. That was sort of specifically prohibited by the Trump rule. But, I think overall, our recommendation is if you are going to offer ESG investments, this first point is really the main thing. It must be based on risk and return analysis, because we could be in a situation where 2 years from now, you could get back to a Trump era type rule that completely flips this on its head. So no matter what you're doing in your plan, bottom line is follow your investment policy statement with regards to ESG investments. So if you're offering them, just make sure that the review and the oversight that you're putting those investment options through before offering them in your plan are the same that you're following for anything else that you're offering in your plan. The other big change on this rule that I think was a bit of a surprise was the fourth point, considering non-financial preferences of your participants when selecting investments for the plan. I honestly think you need more guidance on this. I don't know that if you had a cohort of participants that wanted a specific type of investment in the plan, I would be sort of careful going down that path. If you do go down that path, though, again, same rule applies. Whatever investments people are asking for to be in the plan, just make absolutely sure that it follows your investment policy statement to a T. So that's really anything else on ESG?
No, I think that's it. I think we can move on to Secure 2.0.
All right. Oh, my final point on ESG though is, so if you get a conservative presidential election or a conservative president and you get sort of the Trump era DOL rule, even though there's some pressure against ESG investing, there are so many plans that are using ESG funds. I really think it would be challenging to fully unwind it the way that some maybe want to see. When you look at the number of new products that have been rolled out in probably the last 3 to 5 years, investment products, so many of them have ESG focus to them. So while I think it is a political hot button, unwinding it out of retirement plans, I think would be challenging. All right, so let's move to Secure 2.0. Just as a reminder, at the end of 2019, Secure, what is now being called Secure 1.0, was signed into law, considered to be probably the most substantive overhaul of the retirement system in 10 to 15 years. I don't disagree with that sentiment, but I would say it covered a lot of ground, but it was a lot of piecemeal things, a lot of individual things that I think helped improve the system. And I would say the same is true of Secure 2.0. It was signed into law at the end of the year, also December 29th, 2022, and sort of has a grab bag of different retirement provisions. Both of these, though, I think show a strong interest by the federal government to make plans more accessible. So encourage more employers to offer plans, start plans, and also to improve the opportunities for participants to be in those plans. So we want to get more plans and we want to get more participation in the plans that we have. And I think that's a pretty consistent theme that you see in both Secure and Secure 2.0. Some of the things we see in 2.0, it increases penalty-free access to retirement plans. So there's a lot of opportunities to access your funds without basically without paying the 10% early withdrawal penalty. And for those of you that have maybe been on some of these webinars before, you've heard me express my concerns. The pandemic hit, and really for the most part, we opened up the retirement system to withdrawals. I mean, people really had an opportunity to just raise their hand and say, hey, I've been negatively impacted by the pandemic. I want some money. And there weren't honestly a lot of guardrails on that. That is very concerning to me or anyone who practices in this industry, because that's not really the purpose of a retirement plan. However, I think what we are seeing now that we're through the pandemic is that a recognition that retirement plans hold a large amount of individuals' assets, right? And there are situations where you need to tap into that money to have access to get through, to get through an emergency. And there's a lot of access to the plans, but which I don't necessarily like. But I do like that there are some guardrails and some parameters and some limits on it. And so I do think we'll continue to see an expansion of access to retirement assets, penalty-free retirement access. You also see increased financial incentives for institutions to start plans. Most of this is probably focused on small employers. So employers with 100 employees or less, I think there's really an effort to encourage those employers to offer plans. There's also incentives for plan sponsors and participants to increase participation. So we want to see more participation in the plans that already exist. There's also some other things focused on, I think the other areas that you'll see a fair amount of activity are in required minimum distributions, some changes there, some changes to Roth provisions. So overall, just a whole lot of stuff in here that we'll sort of walk through. As far as the effective dates range from right now, 2023 through 2027. For plan sponsors, a lot of these will require, to take advantage of a lot of these, it will require plan amendments. And for any amendments that are needed as a result of using some of these new provisions, you'll have to have your plan amended by the last day of the 2025 plan, the last day of your 2025 plan year. So let's move into some of the provisions. Candace, and I did set these up. We're going to walk through these sort of chronologically, sort of what applies to 2023, 2024, 25, on through 2027. So with that, I'll turn it over to Candace to talk about some of the provisions for the 2023.
Thanks, Greg. So one of the first things up is required minimum distributions. So effective 2023 this year, as Greg was mentioning, RMDs will begin at the age of 73. Effective 10 years from now in 2033, RMDs will begin at the age of 75. So trying to pushing that back, you see maybe some longevity in life expectancies. And then additionally, there's going to be a reduction in a penalty for failure to take RMDs. So I believe, Greg, correct me if I'm wrong, it was reduced to 25% of the amount, and that can even be down to 10% if caught and corrected within 2 years.
This is a good one. The old penalty was you had to pay, if you failed to take an RMD, you had to pay 50% of the amount that was supposed to be withdrawn was the penalty. And that was a very significant penalty. Some people just missed their RMDs. And to me, that was always unfair. So, as far as a very positive provision, this is certainly one. Again, Candace is right, lowers it to 25%. Is the penalty, and that can be lowered to 10% if the correction is identified and fixed within 2 years. So that's a very good provision.
Thanks, Greg. And the next one is the waiver for early withdrawal penalties. So as Greg was mentioning, you had a lot of people during the pandemic with emergencies accessing their retirement plans. And I think, that's where Congress kind of saw this need for people, at certain times to be able to withdraw that. So certain amounts. So the first one, of course, is terminal illness within 7 years. That kind of makes sense if you're diagnosed with the terminal illness, say in your 40s, and you're not even close to where you could even start, receive that 59.5 age. Just kind of makes sense to have that available, especially with probably, the mounting cost of medical care in the United States. Next is the withdrawal for birth or adoption. So, I think we all saw that in the original act, for $5,000, but this of course helps update it with a repayment within 3 years. So of course, so now you have an option if you're taking that out to be able to kind of recomp that back into your retirement plan to help continue saving towards your goal of a successful retirement. And lastly was declared for federal disasters. So, as all of you know, there's of course a federal disaster declared in California for all the flooding that's been going on. So we've had a lot of, massive climate disasters within the past, just even during the pandemic. There's probably not even enough to count given how many that there've been. And so kind of having access for that, not having to wait for insurance or legislation to help provide support based on a certain incident. This kind of helps people have access to cash when they're probably in a dire strait and need it. So that's 22,000 withdrawal limit within 180 days of the disaster. That would be taxed over 3 years. Increased loan limit to 100K within 180 days, and an opportunity to stop loan payments for 180 days. Anything I missed, Greg?
No, these are, like I mentioned, there's some provisions that kick in 2024 and later that also provide additional access to funds. I think the biggest one is the federal disasters. In the past, what would happen is really only the biggest federal disasters would be available for relief because you had to have legislation for each disaster. I think this is a very positive development. Candace mentioned what's happening in California. It's already been declared a federal disaster. That would immediately kick in the ability for people to have access to their funds, rather than having access 3-6 months after the disaster, which probably isn't when they really need the money. So the other thing I like about this is it does have a limit on it. So the $22,000 limit, not an excessive amount. I think the goal here is to not allow people to really destroy their future retirement benefits with some of these withdrawals, but to help them through a difficult time.
And Greg, most of this would be self-reporting, correct?
Sorry, I didn't hear you.
Most of this would be self-reporting by the participant.
Correct? Oh, yeah. I think that's the other thing that we're seeing across the board is a lot more opportunity to do self-certification.
Yeah, and I think with self-certification, given a lot of the IRS changes that we're seeing here as part of this bill, I think we're hoping to see some guidance from the IRS hopefully later this year. Next is, of course, specific to 403B plans, eligible to participate in PEPs and MEPs. I think one of the things we saw too previously that's also part of this is, if you were participating in a MEP, each plan would have to file an individual 5500 filing. This kind of helps with that, where the MEP can file a single filing and, just kind of help administratively to help clean things up a little bit. It's not perfect. I think there's definitely going to have to be guidance on the IRS on how this would be moving forward. And then, of course, the one bad apple provision. So, Greg, do you want to talk a little bit more about that?
Yeah, I think some plan sponsors were reluctant to, be involved in sort of a MEP because of some provisions that suggest, so you have all these employers that are all in this plan together, and if one of them's not following the rules, or the old way was, the whole MEP might get disqualified. But the new legislation has a provision that if one of the employers within a PEP or a MEP is not following the rules, then it will only impact that employer. So it does provide some protection for for plan sponsors that want to participate in these types of arrangements.
Awesome. And then lastly, collective investment trusts, as we know them, CITs, are still not allowed. So even though this was actually mentioned as part of Secure 2.0, the securities laws, as part of the SEC, is not updated for this. And it was actually mentioned in the bill saying that, until that change has happened, that collective investment trusts would still not be allowed in 403B plans.
All right, we do have a couple questions here for federal disaster withdrawals. This is an optional plan provision. Yeah, I do believe you have to allow for some sort of in-plan distributions. I think a lot of these would require a review of your plan document to make sure, so many of these provisions would require a review of the plan document to make sure that it's available. So for 2023, there's also several plan sponsor provisions. First, we'll walk through these. We've got an increased credit for plan startup costs. This is actually for small plans, so that would be 100 participants or less. It increases the tax credit from 50% to 100% up to $5,000. This is also available if a new sponsor joins a MEP. They can still take advantage of this tax credit. So if you join an existing MEP, multi-employer plan, you can still take advantage of the tax credit as sort of a new startup plan. There's also some special tax credits for small employers relative to military spouses. So a lot of opportunity for small employers to establish a plan. There's also this inclusion of de minimis financial incentives to encourage participation. The most common example that I'm seeing is, gift cards or something like that you can give a participant for signing up in the plan. That would have been a prohibited transaction prior to this. So it does allow for an employer to take some action to try and increase participation. One note on that, though, whatever expense is incurred to provide these de minimis financial incentives, it cannot be paid out of plan assets. So that would have to come out of the plan sponsor's regular operating budget. Simplified notice requirements for eligible and non-participating participants. So prior to this, there are all these notices that tend to go out to your participants, and many of them were required to go to your non-participating participants. This is going to change that. I think we'll need some more guidance on exactly what can be provided, but I think for the most part, it looks like it'll just be one annual notice to all your non-participating eligibles to indicate that they have an opportunity to participate, but they don't have to get all the fund change notifications and things like that. Plan sponsors will have the election to not recoup overpayments to participants. So, it's not all that uncommon to have an additional payment or an error in payments go out to a participant. Will allow a plan sponsor to elect not to try and claw that money back. And even for those plan sponsors that do try to recoup overpayments, there's some rules and regulations around what they can do to sort of protect the the individual. Increased reliance on employee self-certification for hardships. And again, I mentioned earlier, a lot of these, we are seeing more reliance on self-certification. As it was before, employees could self-certify their financial need, but they couldn't self-certify the reason that they wanted the hardship. So this just makes sense. Now they can essentially self-certify all aspects of the hardship. After tax Roth opportunity for employer contributions. This is a pretty big one. This would allow a participant, to the extent that you can handle it administratively, right? Because there's going to be some record keeping issues with this. But to the extent that participants want the employer match or the employer contribution to be contributed on an after-tax Roth type basis, a plan sponsor could offer that opportunity. Now, that's certainly something you don't have to offer, but it's something that you could offer. And then the final one for 2023 is an extension of the amendment period for 457B plans. There was an amendment that was required by the end of last year relative to required minimum distributions. I think most plan sponsors probably already put that in place, but if they didn't or missed it, that's extended out to 2025 as well. So that takes care of 2023. Now we can move on to 2024 provisions. Oh, you're on mute.
I am on mute. Perfect. Thanks, Greg. So more about RMD provisions. That seemed to be an ongoing theme as part of Secure 2.0. So one of the things is the surviving spouse may be treated as a deceased participant, and the RMDs are not required not required for designated Roth accounts. So, some additional things there, emergency saving options. So one of the other things that was mentioned was a sidecar account that would be up to $2,500 of Roth type contribution. And then additionally, separate from that would be a penalty-free withdrawals up to $1,000 a year for any emergency. And, repayment would be required prior to taking another withdrawal, but I think you'd have about 3 years to repay it. So, there's some options and some wiggle room here. I think this is one of the things that we saw as part of the legislation where people are really trying to provide additional emergency saving options so people aren't having to dip into their retirement account and, try and take some of those penalty-free withdrawals. And especially with the complications of self-certification, I think they're hoping this offers some sort of, alternative option. Next is the waiver for early withdrawal penalties. So self-certification for domestic abuse, it would be up to $10,000 or 50% of the account value. So that's, I think kind of a big thing. Another emergency situation where, let's offer an opportunity for them to be able to have access to funds in a serious situation where somebody would need some help. And then last but not least would be the 403B plans, related specifically to 403B plans, would be expands the source of availability for hardships to match 401k plans. So, this is already available in 401k plans. This was just a kind of way to match up what's available for DC plans on both the 401k and the 403B side. Anything I missed?
No, I'll maybe add a little color to a few of these. I think a couple of them are just cleaning some things up. The RMDs not being required pre-death from designated Roth accounts. That just brings that in line with what the rule has been for Roth IRAs. So it just extends it to retirement plans. Again, looking for some consistency across the system. Same is true with the 403B plan provision relative to hardships. This just brings this in line with what we see in 401k plans. Just for a little more on that, the old rule sort of limited the money available for hardships only to the employee contributions. It couldn't even take into consideration earnings off of that, but 401ks could. So, I think every time there's any legislation, there's always something in there that brings 403bs and 401ks a little closer together. I think the emergency savings options, this one's interesting. So, why do we have two provisions? My understanding is the House had one emergency savings provision and the Senate had their version, and no one would capitulate or pick one or the other. So we ended up with two. So you've got this sidecar account, which, I think, well, first, going back to emergency savings, I think there's a recognition that people do not have enough assets available to get them through a one-time short-term emergency. In fact, I think the report I saw was that half of Americans would struggle to pay just even a $400 surprise bill. So, I think access to some funds is important. While I don't love people dipping into their retirement accounts, I've been pretty clear about that. I do like this provision. I think it's got the guardrails that are appropriate, but they're both different, right? So this sidecar account requires additional record keeping, absolutely additional complexity with this. This will be a separate account that would hold up to $2,500. The plan sponsor selects the investment for that. So you don't get the opportunity to direct your investments in that sidecar account. It has to be invested in something conservative, more likely than not a money market type investment. So, I think for a plan sponsor that sets this up, it does very clearly delineate to the employee, this is short-term money that I can use for an emergency. This is retirement savings money that's long-term. The other option, the penalty-free withdrawal, of course, that $1,000 will be invested in there. That just comes right out of their retirement account. So much easier to administer, much easier to just open the door and say, hey, we're going to make it available $1,000. It doesn't mean that it's invested conservatively within their plan, though. So they may be taking it out at a bad time relative to what's happening in the market. There's no requirement that $1,000 be held aside and invested conservatively. But it also does have the opportunity to repay. So you can repay within 3 years. If you take $1,000 and never contribute anything else to your plan for the next 3 years, after that 3-year period, you could access it for another $1,000. I think that's it. The only other thing I would add, on the domestic abuse, well, you do have 3 years to repay that as well, and any taxes you would pay on that would be reimbursed. This 3-year repayment concept is popping up in everything, and when you think about these provisions and some of the access to retirement plans, I think here in just 2023 and 2024, we probably listed 5 to 6 different ways that people can access their retirement plans on a limited basis without facing an early withdrawal penalty. Candace, anything else?
No, I think that was some great color and additional items to add to that. So,
all right, moving on with some 2024 provisions. Employer matching contributions for student loan payments. This one has been out there for quite a while. I think it's well deserved. There's no question. It is very clear that individuals who are struggling with a large amount of student debt struggle to save for retirement. What this provision will allow is if an employee can show that they are paying off qualified student loan in a matching plan, then that employer could take the matching contribution and put it in, even though there aren't any employee contributions going into the plan. Again, this is one that I think the devil's in the details a little bit. I don't think it's really clear how the employer is verifying that the payments were indeed made. So I think there's a little bit more that we need to learn before it's adopted. But overall, I think very positive opportunity to help people, allow them to pay down their student debt and not forego retirement savings. This next one's a big one. 2024, catch-up contributions must be after-tax Roth savings for individuals earning over $145,000. So if your plan does not currently offer Roth type savings, you probably want to look at that and see if it's something you want to include. If you think about who typically uses the catch-up contribution, it's probably your highest paid individuals who have the ability to take advantage of that. Not always, but that's usually who it is. And so you would want to make sure, if they, to the extent they want to continue making their catch-up contributions, your plan will have to offer the ability to put those in as Roth contributions. I think when this one originally came out, it was going to require all catch-up contributions to be after tax. Oh, here's a question. Catch-up 145,000, is that prior year comp? I don't know exactly what the compensation standard is. I think it is the prior year comp, but I don't know exactly what it's based on. So again, I think we need some more guidance on that. There's another question on student loans. Is the match separate from or part of regular matching contributions? It's my understanding that it's the regular matching contribution. So let's say you have a 50% match on the first 5% that the employee contributes. To the extent the employee can show that he or she put in 5% into paying off student loans, then that employer could go ahead and put the 50 cents on that 5 cents and 5% in there. There are some other regulatory agency requirements for 2024. The IRS has 2 years to update the employee plans compliance resolution system, which allows people the opportunity to correct plan errors. Some of these are even going into effect immediately. I think one that is in effect immediately is the ability to correct automatic enrollment and auto escalation errors. You have 9.5 months to complete that. So there were a few things that will change the correction process right now, but overall the IRS has to update the entire system. The DOL, this is an interesting one. Within 2 years, the DOL needs to develop a lost and found database. The way this would work is the database is for participants to go in and identify who the contact would be at a former employer so that they can reach out and see if they have any lost assets. So it will have, it'll require employers to put contact information in, but ultimately the lost and found database is being created to help participants help them identify their lost plans. There's a few other things that I think the DOL is being required to sort of update some of the participant disclosure regulations relative to target date funds. I think there's some concern that there aren't really good index comparison funds, so they have 2 years to review the comparative funds for target dates. And then also there's going to be a review of 402F rollover notices for participants. So those are a couple other things we see coming down the pike. Outside of plan sponsors or regular retirement plans is this IRA practice pointer effective in 2024. Anyone who has 529 education savings plans can actually roll over up to $35,000. That's not $35,000 a year, it's $35,000 total to a Roth IRA for the beneficiary, penalty and tax-free. There are some rules on this, so anybody who thinks they're just going to go roll over to the Roth IRA tomorrow, you do want to follow some of the rules. That 529 plan would need to have been in existence at least 15 years, and you cannot roll over contributions that were made within the last 5 years. So this is really a provision that is meant for an individual who maybe, or a beneficiary of a 529 plan who maybe didn't go to college or maybe got scholarships and funded their college through another means. It does give an opportunity to shift some of that over to retirement savings. Moving on to 2025, Candace.
Yeah, so as Greg said, in 2025, some of the things we expect to see is, of course, the auto enroll and auto escalate for new plans. So there would be a required deferral of at least 3% and an annual 1% increase to 10%. So this wouldn't be effective until 2025, but if you are doing a startup plan, that would be effective as of December 31st, 2023. So something to keep in mind. Next, of course, is the increased catch-up contribution. So employees age 60 to 63 can contribute the larger of $10,000 or 150% of their regular catch-up amount. And then lastly, this one's kind of a big one, long-term part-time employees, reducing the time frame from 3 years to 2 years for allowing long-term part-time employees to participate in the plan. So this is 2025, something to be cautious there. Is that, if you do want to participate in that, and that's something that you think you might want to add, it does require the tracking of hours, and that's an additional administrative hurdle that you might have to think about if that's something that you're looking towards. Greg, anything to add to that?
No, the auto enroll and auto escalate, I honestly didn't think this was going to get in there. I didn't think there was any way it would pass. I just thought there would be some sensitivity to forcing people into a plan and then doing auto escalate up to 10%. I mean, I think 10% is a pretty significant contribution rate for a lot of people. So we'll see how this rolls out. I mean, I think one of my concerns is if you auto escalate, maybe someone's comfortable doing 3%, but then after 5 or 6 years, when they're auto escalated up to 7, 8, 9% of their pay, they might look at it and say, I got to stop doing this. I need that money. So, but overall, one of my comments at the beginning was that a lot of these provisions are focused on increasing plan participation. And it is absolutely true that plans that use auto enroll have significantly higher participation rates. And so auto enroll has been around since 1998, but I would say it really only got legs in the last 5 to 7 years. Where you really see a lot of employers adopting auto enroll. And I think the fact that people don't opt out when you opt them in is very positive and is a very good thing for the overall retirement system. The increased catch-up contributions, I think it's great to give people an opportunity to save more for retirement. I think administratively, this one will potentially present some problems, right? You have to sort of keep track of when people can put in more than what the stated amount is for these 4 years, and then you have to stop it after they hit age 64. So, a lot of good provisions in here, but so many of them have some administrative complexity that they add to our retirement system. So moving forward with 2026 and 2027 provisions, these ones are a little further out. Again, another opportunity to access your retirement funds penalty-free. In 2026, you could start using up to $2,500 a year to purchase or to cover long-term care insurance premiums. So that'll be coming. Another requirement was for paper statements. I think there was some concern, excuse me, there was some concern that as you have older participants retiring and accessing their money, there was some concern about shifting the entire system to all e-delivery. So there is a return to paper statements. For defined contribution plans, you would be required to send at least one paper statement a year. And for defined benefit plans, you would have to send one paper statement every 3 years. The final change, which is a pretty big one, is the savers match. Now, there is a savers match now that allows for lower income participants to get a tax credit if they are participating in a plan. This would change and would actually allow for 50% of the contribution up to $2,000 matching. Rather than getting a tax credit in 2027, this would change this and allow them to the federal government apparently will put the money in the participant's account. So, I guess somewhere on the tax return, if you're eligible for this, you would want to you would probably have to give them direction of where they're supposed to send your $2,000, whatever the amount is. Just to give you an idea of who's eligible for that, it does phase out over time, but it's married couples making $41,000 to $71,000 are eligible for this credit. Single taxpayers, it's just half of that, $20,500 to $35,500 to be eligible for that credit. In 2026, the Department of Treasury is required to promote an education campaign related to the Savers Match to increase that participation. So that covers a lot of the provisions. We do have a couple questions here. There's one relative to back to MEPS, which I'm not sure I understand the question. Will there be a carve out? I might have to reach out to that individual and understand that question a little bit better. Are you required to allow pre-tax catch-up for someone earning less than $145,000? Could your plan require all contributions to be Roth to reduce the complexity of how it would work for everyone in the plan? Oh boy, could you require all catch-up contributions to be Roth? I think you probably could. I think we're gonna need some more guidance on that to really be certain. Politically, I would probably want to understand the impact that it would have on participants. I think some people have strong opinions of what's better, Roth savings or pre-tax savings. And if individuals specifically are trying to lower their current tax bill, they might push back on that type of provision. However, that's what's in the question is, I completely agree that it makes it easier to administer if everything goes in either after tax or pre-tax, rather than trying to track salaries and make sure that you have the right people doing the right type of contributions. I think the opportunity to make errors in that is probably fairly high. I think that covers all of our questions. Candace, anything else you would like to add?
No, I think we've kind of touched on this. I think, be careful where there's potentially some complexity in administration, as Greg was just mentioning. You might have to talk to your record keeper to see if that's available. Some of these provisions, of course, are 2024, 2025, 2026. So I think there's some time until we get to that point that hopefully allows for some people to potentially work out the kinks. But I think one of the other big things that you mentioned is that I think there's going to be a lot of guidance. Sorry about that, to really help people understand, how best to administer this, what's the best process moving forward. I think especially, a lot of this, as I said, kind of tax implications, how best, we're probably going to need some guidance from the IRS, some regs, to really kind of help give some examples of what this would look like moving forward.
Yeah, I agree. Let's see, there's one more question. There's a question related to 5500s and the long-term part-time employees. And I think I'll have to get back to that individual. I think there's more information that's needed on how exactly that provision is going to be put into place. I do know, and I think Candace mentioned it, as it relates to the long-term part-time employees though, one thing to keep in mind, that does not make them eligible for employer match or employer contributions. So it only gives them the opportunity to defer their own money into the plan. And one thing that I have seen is some plan sponsors are saying, rather than trying to track these hours and make sure I'm letting the right people into the plan, I might just let part-time employees defer immediately or after a month or two or something like that. So that is one provision that we're seeing change. Overall, I think this is very positive developments. I think one thing that both parties do appear to be able to agree on is some improvements to the retirement system. So between Secure Act and Secure 2.0, we've made some real good progress. Again, I don't love people taking money out of their retirement account, but I think a lot of this access, for some of the reasons that are provided, is helpful and hopefully will encourage participants to participate more. If they know that they can have some limited access to their funds, they may be more likely to increase their savings. So again, overall, very positive developments. A lot of these are going to take place, now in 2027. At Multnomah Group, we will continue to monitor all these and update you accordingly. All right, and with that, we will close the webinar. Thanks, everyone.
Thanks, everyone.